Welcome everyone to the Kindle Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Don't forget to subscribe, hit that like button, and share these videos. Over the years, I've talked to many of our advisory customers about leading and lagging performance windows. What we're going through right now is similar to that concept, is that there's an effect and then there's a lag. Many times in portfolio management, styles and different asset classes will be in and out of favor. We're going to see something very similar. What we're likely to see is that the event happens, there's a lag, and then we see the outcome. First, the economy gets shut down, then we see the unemployment. So the event and then the lag. And over the past 5 weeks, we've now seen unemployment requests be up to around 30 million. The ADP report showed a 20.2 drop in unemployment. We're just a couple days away from the employment numbers on Friday. We're likely to see unemployment move somewhere between 12 and 18%. Just for a little bit of perspective, in the Great Recession in 2008 and 9, what we saw then was about 2.3 million people out of work. So this current event is 10x what we saw then. We're looking at 22 million minimum and closer to 30 million, and the unemployment numbers may not have a match since the 1929 Great Depression. Meanwhile, we've seen the Fed come in and do massive stimulus, and one of the things that happened prior to this event, the currency in circulation was about $2.5 trillion. Well, just with the Fed's action and the stimulus that the administration and the Treasury has put into play, we now have $4.5+ trillion. They've doubled the amount of currency in circulation. They've added a lot of liquidity in the system, and this is most likely why all of us are confused on why Main Street and Wall Street are so disconnected. We look at the fundamentals, and we would expect to see the markets completely collapsing. Meanwhile, the NASDAQ is trading virtually unchanged on the year. I talked about this on the live stream on Wednesday. Makes sense the technology companies aren't affected like the brick and mortar and the airlines and other elements in the economy that are being directly affected by the shutdown. So what's likely to happen next? I've discussed this before, but we won't have a clue on what businesses will survive, what the economy will look like from a social environment, and how people are going to come back and respond as we go forward. But if you think about lingering effects of 20 to 30 million people being unemployed, this is going to be the main factor that ultimately I believe the markets will have to deal with. In spite of the stimulus, once we know what businesses fail, which ones will go forward, and what percentage of the population will actually get back to work, that's when we'll be able to address and evaluate what the market's really worth from an earnings and economic viewpoint. We'll be operating on the stimulus and the Fed money to float the economy for now. The next wave will be defaults that will happen in real estate, primarily in commercial and apartments, and then flowing over into residential. We could see another replay of all the REOs, all the repos that the banks will end up owning these properties. That may be a natural flow as things unfold. For right now, we're going to continue to see the markets remain in this very choppy range. There will continue to be an underlying bid in this market, and we may even be able to move it much higher in spite of the backdrop of the economy. It will likely take 4 to 6 months before we understand the real effects of what this shutdown has really done. And at that time, and only at that time, will the markets have to deal with real fundamentals. For now, we'll continue to look at the technicals to lead us through this period until fundamentals start to come into play and we can evaluate them. Let's take a look at the charts and see what they're telling us for the balance of the week. We'll start by reviewing the futures contract. Overnight, we're seeing a strong move up 0.91, up 25 handles, trading back to the 10-period moving average, which is at 2860.70. last price 28.59 even. So we're back to that level. And what we're doing, and I talked about this on the live stream, we're sandwiched between the 21 period moving average and the 10 period moving average. Now this pattern, while it was starting to fade yesterday, is flipping again. Meanwhile, as I discussed, our models are still long. We're climbing the angle of the 21 and the 10 period moving average, which are up 0.27 on ppm1 and ppm2 up 0.37, and anything over 0.25 is an uptrend. So we're continuing to be supported by this uptrend. The 21 is the primary trend line. I also refer to as a demand line. This is pushing the market higher. You look over on the left-hand side here, you'll see that the ppm2 is at 0.37. So this is supporting the market. Overnight, the market traded down to 28.23 on the futures. The 21 period moving average is 28.22.10. So basically a direct hit. We bounced up and now we're trading in between the two moving averages. Looking at the WaveTech rangefinder, the resistance is at 28.64, 28.80, and the extreme at 28.95. Yesterday we traded just short of Monday's high. We saw a reversal, but we're seeing this rebound once again. We're also seeing the situation I've been discussing for the past several sessions is as we come into the London Open, there's a bid in the market pushing the market higher. Now we saw that follow through in yesterday's session into a much higher opening and strength early on. Then the market flipped when it failed to get through some of the resistance points yesterday and closed at the low of the session. But this back and forth action is being dominated because of the angle of attack on both the 21 and 10 period moving averages that I just discussed. So reviewing the pattern again, we've got this 5-wave pattern that is unfolded. This right here is wave 5. Now we're seeing this A, possibly a B wave, and there should be one more leg down. The key will be the 29.20 level. At this level here, it'll close above that level, then we will take out last week's high and run toward the 200-day moving average, which on the futures is 29.92. It's a little bit over 3,000 on the cash market. The pattern that I've drawn on the screen is the most likely pattern to unfold over the next couple of days, with the caveat that that 29.20 number is going to be your pivot. From a trading standpoint, you should be able to sell up against that number if we get a little bit higher. We're only at 28.57. You'd have to rally at least another 20 plus points to be able to take a trade here. But you're looking to sell against that resistance point and then looking for a move down, as I discussed last night, between 27.75 and 27.40. The extremes right now are 26.55. Basically, the configuration I've been talking about still is in play. This is the way it should set up over the next 2 sessions. Still looking for the potential for a failure, but these PPMs still being in trend mode are going to supply a substantial amount of support. This will complete the broadcast for tonight. Thank you so much for coming and showing up at the live stream today. We'll continue to do those as we go forward. Have a great day trading. We'll talk to you tomorrow night.